Welcome back. Accounting 101, Chapter 4, Completing the Accounting Cycle. In this chapter, we're going to learn how to prepare a worksheet, prepare closing entries in a post-closing trial balance, explain the steps in the accounting cycle and how to prepare the correcting entries, and identify the sections of a classified balance sheet. So we'll start with preparing a worksheet. In this case, a worksheet is a multi-column spreadsheet used in the adjusting process and in preparing financial statements. It is not a permanent accounting record. It is prepared using a 5-step process, and the use of the worksheet is optional. Okay, so that means we don't have to do it, but I think it's a good way to step through what is happening and the things that we've talked about already, and then what we're going to learn with the closing entries in this chapter. And it's a good way just to kind of see everything at once. So the way this looks is we're going to have a number of columns across the top: trial balance, adjustments, adjusted trial balance, income statement, balance sheet, and a debit and credit column for each of those under those headings. So the first thing we do is we're going to prepare the trial balance. We've seen how to do that before. We're going to show the adjustments that we're going to need to make in a debit and credit column format. That will then allow us to create the adjusted trial balance, again in the debit and credit format, and then from the adjusted trial balance move the balances to the correct columns, either on the income statement or on the balance sheet, again in the debit and credit format. So if this is our trial balance, we have the accounts listed, we have the debits listed, the credits listed, and debits equal credits. When we do the adjustments, we can add those to the next two columns, debits and credits for the adjustments. And you'll notice in this case we have additional accounts at the bottom that were not part of the unadjusted trial balance because they didn't have a balance in them until we did the adjusting entries. Okay, the way you read this is we've got these A's, B's, all the way through. If you match those up, you can match up the debits and credits. So for supplies expense, we debited that 1,500. We noted that with an A. If we find the A up above, it goes to supplies. We credited supplies 1,500. So that's that entry. So you can continue down and see those. For service revenue, we have two entries, a 400 and a 200. D is the first one. We credited service revenue 400. The debit is going to be up above to unearned service revenue. So that's the D there. That's the 400 that matches. E, $200. I don't see an E up here, so if I look down to where the E is, there's a debit to accounts receivable for $200. That's the adjusting entry. Debit, accounts receivable, credit, service revenue. So that's how you would read that column. And again, total of debits equal the total of credits. The adjusted trial balance. We saw in the previous chapter that creating an adjusted trial balance after we've journalized and posted the adjusting entries were just to take the updated balances. But when we're doing the worksheet, we're going to add or subtract across accordingly. Okay, so what does that mean, add or subtract? If it has a debit balance, we're going to add anything in the debit column in the adjustments and subtract anything in the credit column. So let's take the supplies as an example. We had a debit balance of 2,500. The adjusting entry we did was to debit supplies expense down at the bottom and credit the supplies account 1,500. So if I take 2,500 debit, I have a $1,500 credit. That's reducing that debit balance. So my new balance is going to be a $1,000 debit. Okay. If we have an account where the adjusting entry is the same as what the balance is, we're going to add them. So if we look at salaries and wages expense on row 15 here, we had a debit balance of 4,000. The adjusting entry we did was to debit salaries and wage expense, credit salaries and wages payable down here at the bottom, So now under the salaries and wage expense, we have a debit. We're adding a debit, so we just add those together to get the new debit balance. So as you're doing these worksheets, just be aware of debits and credits. If it's a debit and you debit it, you add it. If it's a debit and you credit it, you subtract. If it's a credit and you debit it, like here in unearned service revenue, you're going to subtract to get the new credit balance. If it's a credit and a credit, in the case of service revenue, you add them. So just watch the column headings and understand what is it increasing or decreasing the account balance. So once we've got the adjusted trial balance, we can then break up the balances into either income statement or balance sheet. So we're going to analyze each of the accounts, determine if it's an income statement account or a balance sheet account, and then move the balance. We're not adding or subtracting, not changing the balance, we're just moving it to the correct columns. So cash, that is a balance sheet item. It's got a balance of $15,200 in the adjusted trial balance. We show that in the balance sheet, debit column, $15,200. If I move down to row 13, service revenue, I've got a adjusted trial balance of $10,600 in the credit. Revenue belongs on the income statement, so I'm going to move it over to the income statement column under the credits. So if I go through all the accounts and do that analysis, I can then add up the columns. And if I look at the bottom, under income statement, my debits are $7,740. My credits are $10,600. They don't equal. My balance sheet, debits are $22,450. Credits are $19,590. Those don't equal. What do we need to do to make this become in balance? But you also notice there's not a double underline, so we're not done. This next slide, we're going to put a debit in the income column statement of $2,860, and that's going to represent net income. How did we come up with that number? We took our revenues, credits of the income statement, minus our expenses, the debits on the income statement. That difference is the $2,860. I put that in the debit column, and now my debits and credit equal in the two income statement column accounts. I put that same amount, the $2,860, as a credit on the balance sheet columns, and then now my balance sheet is in balance. So in essence, we're taking our net income, putting it on the balance sheet, and how we do that is part of retained earnings. So if you remember, taking the income statement, net income goes into the statement of retained earnings. The balance on the statement of retained earnings goes into retained earnings on the balance sheet. That's what we're doing in effect with this here. Now note, if you come across an example where expenses are greater than revenue, so we have a net loss, these would just be opposite. You would be a credit on the income statement and a debit on the balance sheet to make these balance at the end. So it's another way to check yourself to make sure you're representing net income or net loss correctly, that after you put those entries in, the two columns, debits and credits, have to equal. Review question. Net income is shown on a worksheet in income statement debit column only, balance sheet debit column only, income statement credit column and balance sheet debit column, or the income statement debit and the balance sheet credit. We'll go back one to refresh ourselves on what we did. Net income is here. It's a debit on the income statement. It's a credit on the balance sheet. So our answer is D, income statement debit column, balance sheet credit column. Again, that's for net income. It's a net loss would be the opposite. Now we can prepare our financial statements from the worksheet. The income statement is prepared from the income statement columns. The retained earnings statement and balance sheet are prepared from the balance sheet columns. Companies can prepare financial statements before they journalize and post adjusting entries. So going through the process we just went through, if we did that, the adjustment columns are just coming up with what the adjustments are. It doesn't mean that we've adjusted and posted those, or actually done the journal entries. So now we can create the financial statements, and then we can go journalize and post the adjusting entries. Okay, so either way is appropriate, and you can be done. It's just a matter of style and how you want to approach it. So here's our income statement. So using the data from the worksheet, our service revenue was $10,600. We listed all of our expenses, total $7,740. Recall those were the balances in the credit and debit columns on the income statement. The difference is our net income, $2,860. That's what we showed in the debit column of the income statement and also in the credit column of the balance sheet to make those columns, debits and credits, equal. And our retained earnings statement, we had no beginning retained earnings, our $2,860 net income from our income statement. From our worksheet, we saw that we had dividends of $500, so we're going to subtract that. Our retained earnings is $2,360. And then finally, the balance sheet, we list our assets, we list our liabilities. We can get those straight off the worksheet. If we've done those, moved those balances over to the correct columns, we can just copy that data down into the balance sheet. We have our common stock. The retained earnings is from our retained earnings statement. From the worksheet, it's our net income at the bottom, less our dividends that's already listed. It gets our $2,360 retained earnings balance, and our assets equal total liabilities and stockholders' equity. We can now prepare our adjusting entries from the adjustments columns in the worksheet. The journalizing and posting of the adjusting entries, if we're doing this process, follow the preparation of financial statements when a worksheet is used. Okay, so if we do the worksheet, we do the adjusting entries after we've done the financial statements. If we skip using the worksheet because that's an optional step, we can do like we did in Chapter 3 where we do our adjusting entries, create an adjusted trial balance, and then prepare the financial statements from there. So Susan LB is preparing a worksheet. Explain to Susan how she should extend the following adjusted trial balance accounts to the financial statement columns of the worksheet. Okay, so we have a list of accounts. We need to decide, is it in the balance sheet column or the income statement column? And within each of those, is it debit or credit? So cash, that is a balance sheet and it's in the debit column. Accumulated depreciation equipment, it's balance sheet credit column. Accounts payable, it's a liability, it's a balance sheet credit column. Dividends reduces our stockholders' equity, so it's on the balance sheet debit column. Service revenue is on the income statement in the credit column. And finally, salaries and wages expense, income statement, debit column. Next, we'll talk about closing entries and a post-closing trial balance. So at the end of the accounting period, the company makes the accounts ready for the next period. Temporary accounts are closed at the end of the period. Permanent accounts are not closed from period to period. Okay, now we've got some new terminology. We've got assets, we've got liabilities, stockholders' equity, and now we're going to say the accounts are temporary or permanent. A lot of classifications in accounting. So what are temporary and permanent accounts? Temporary accounts are all revenue accounts, all expense accounts, and dividends. So income statement accounts and the dividends is temporary. All assets, all liabilities, all stockholder equity accounts are permanent. Those are the balance sheet. Okay. The thing that as we do the closing entries, we're going to take our net income and our dividends and close it into retained earnings. We'll see how to do that, and that becomes a permanent account. So the closing entries formally recognize in the ledger the transfer of net income or net loss and the dividends into retained earnings. Okay, so revenue and expense is on net income, dividends is in the statement of retained earnings. Those are all temporary accounts. We're going to transfer those balances into retained earnings, which is a permanent account on the balance sheet. Companies generally journalize and post closing entries only at the end of the annual accounting period. So we don't necessarily have to do this at the end of each month when we close each monthly accounting period. We typically just do it at the end of the annual accounting period. And the reason we do it is to produce a zero balance in each temporary account so that at any point in time during the year, we can look at the balance in those temporary accounts and know what we have incurred or earned in revenue and expenses for the year. So whatever that balance is a year-to-date balance. Okay. Now here's what it looks like graphically. We're going to take revenue accounts and close to income summary. Expense accounts are going to close to income summary. The balance in our income summary account is then going to be our net income or net loss. We're going to close that income summary account into retained earnings. And then we take the balance in our dividends accounts and close those to retained earnings. So how do we do that? So here's our income statement for the month ended October 31st, 2027. We have revenue, we have a number of expenses. Our net income is our $2,860. And our closing entries look like this. So the first one we do is we're going to debit service revenue, $10,600, and credit income summary, $10,600. Okay, so revenue has a credit balance from our income statement. Here on this slide, we see that it's got a balance of $10,600. That's a credit balance. So to close that and make the service revenue account zero, we're going to debit service revenue and the credit to income summary. Next, we're going to close the expense accounts. So we take each of the expense accounts, the ones that are how they're listed on the income statement as a debit balance. So we're going to credit each of those accounts and debit the total to the income summary account. Okay. Note that we have to separately list each expense account. We can't just say debit expense because we have to do each account separately. And I'll show you why in the next slide. Once we've closed revenue and closed expenses to income summary, we take the balance in the income summary, which is a credit of $10,600, a debit of $7,740. So we have a credit balance of $2,860. We're going to close that to retained earnings. So we debit income summary, $2,860, credit retained earnings, $2,860. So that's our net income again that we're closing into retained earnings. Then we have $500 of dividends. Dividends is part of DED, so it's got a debit balance. We're going to credit that and debit retained earnings, reduce retained earnings. Now we'll look at the ledgers after we close these. So starting with service revenue on the right here, we've got a balance of $10,600. We're going to credit that when we close it to income summary. So the balance now is a balance of zero. We have credits of $10,600. We just created a debit of $10,600. So it's zero. We close that in as a credit to income summary. And here's why we have to list all the expense accounts separately, because we have to go into each one and post that entry, that closing entry, to make each account zero. So we add those up and we have our debit $7,740 to income summary. That gives us a balance of the $2,860, a credit balance. When we close that to retained earnings, we're going to debit income summary and credit retained earnings. So that increases retained earnings. And then we close dividends by debiting retained earnings, crediting dividends. Dividends now has a zero balance. Our retained earnings now has a balance of $2,360. And if you remember from a few slides ago when we did the statement of retained earnings, our ending balance in our statement of retained earnings was that $2,360. We've just now taken that income statement, closed those accounts, the dividends, closed those accounts, and created that balance truly in our retained earnings account. Virtual close. So technology shortened the closing process. Average company now takes 6 to 7 days to close rather than the previous 20 days. But a few companies can do better than that. So Cisco Systems state that they can do a virtual close where they close within 24 hours on any day in the quarter. Same is true at Lockheed Martin, which improved the closing time by 85% in the last few years. Managers of these companies emphasize that this increased speed has not reduced the accuracy and completeness of the data. Okay, knowing exactly where you are financially at any time allows the company to respond faster than its competitors. Also means that the hundreds of people who used to spend 10 to 20 days closing the books, looking at the transactions, doing the adjusting entries, can now be used on other projects, so mining data for business intelligence, looking at the analysis, and that type of thing. Who else benefits from a shorter closing process? Well, that will be investors. So if it's a shorter closing process, the company can announce their earnings and their financial results sooner, which gives the investors quicker data and it's more relevant for them. Now that we've done our closing entries, we can prepare a post-closing trial balance. That's simply looking at the permanent accounts and listing their balances, debit or credits, and making sure that our debits and credits equal before we start the next accounting period. Let's go through another example. Hancock Company has the following balances in selected accounts of its adjusted trial balance. So these are the balances after we've done the adjusting entries. We're supposed to prepare the closing entries at December 31st. What is the first closing entry we do? We're going to close revenue to income summary. So that'll be the first one. We have one revenue account, service revenue, $98,000. So we're going to debit service revenue, credit income summary. Then we're going to close our expense accounts. So all the expense accounts, rent expense, supplies, salaries and wages. We're going to credit each of those accounts for their balances that's listed here, and then debit income summary. And that's what those two entries look like. Once we've closed revenue to income summary and expenses to income summary, the third entry we do is to close income summary to retained earnings. We have a credit of $98,000, a debit of $80,000. So a credit balance of $18,000 in that account after we do these two entries. So we're going to debit income summary and credit retained earnings. And that's this third entry here. And then finally, looking back at our accounts, we have dividends of $15,000. We close dividends to retained earnings. We're going to debit retained earnings to $15,000, credit dividends $15,000 to close the dividends to retained earnings. So those are the closing entries. Next, we'll look at the steps in the accounting cycle and how to prepare correcting entries. So we've seen these 9 steps before, but we've typically seen them across the bottom of the slide or on the slide kind of going left to right, but it's the same steps. We analyze transactions, we journalize the transactions, post the journals to the ledger accounts, we prepare a trial balance, journalize and post adjusting entries, our deferrals and accruals, we prepare an adjusted trial balance, prepare financial statements, we journalize and post closing entries, and prepare a post-closing trial balance. So we'll step through these. Analyzing the business transactions. That's where we had the accounting equation, listed the accounts underneath them, and put the amounts from the different transactions in the appropriate columns. Then we took that data and we can journalize them, put debits and credits, put it in the proper form for a journal. We show that there. Once we've journalized the transactions, we can post them to the ledger, where we copy the data from the journals into the appropriate accounts. That allows us to get a balance for each of those accounts. Once we have the balances at the end of the accounting period, so in the end of the month in this example, we can take those balances and put it into a trial balance. After we have the trial balance, we can analyze the accounts and determine what our deferrals and accruals are. And we can create those journal entries for deferrals and accruals, the adjusting entries, and then post those adjusting entries into the ledger again. Once we have that done, we can create a adjusted trial balance. So we'll highlight the red numbers there, the new ones that we have that weren't on the trial balance before. And then once we have the adjusted trial balance, we can prepare our financial statements, our income statement, statement of retained earnings, and our balance sheet. Once we've done our financial statements, we can then do our closing entries where we close our temporary accounts. So revenue into income summary, expenses into income summary into retained earnings, dividends into retained earnings. And then once that's complete and posted, we can do a post-closing trial balance, which just shows that the permanent accounts debits equal credits. Now we'll talk about correcting entries. Okay. This could be an avoidable step if all the accounting records are free from errors. Okay. Most likely will not happen. Errors happen. People are human. Mistakes happen. But if we discover an error, we can correct it, and we must do all of our correcting entries before we do the closing entries. Closing entries is going to be the last step in the annual accounting cycle. So we're going to look at preparing correcting entries. There's another way to correct errors. So we can reverse the incorrect entry, which just means use the same dollar amounts, the same accounts, and just do the opposite. So if we debited something, we're going to credit it, and so on, and then prepare the correct entry. But a lot of times doing a correcting entry, it's a little bit simpler and a little bit easier. So let's look at an example. On May 10th, Mercado Company journalized and posted a $50 cash collection on account from a customer as a debit to cash $50 and a credit to service revenue of $50. The company discovered the error on May 20th when the customer paid the remaining balance in full. Okay, so when we collect on account cash from a customer, what we should have done is this right side over here. We should have debited cash and credit accounts receivable. So that's the correct entry we should have made. But what we did instead is we debited cash and credited service revenue. Okay, so that's the incorrect entry. To correct this entry, we're going to debit service revenue. So take that credit and offset it with the debit so that the net is zero. And we're going to debit or credit accounts receivable. That's the thing that was missing before. We did not credit accounts receivable, so we do that in the correcting entry. Our description is to correct the entry of May 10th. And now all of our accounts have the correct balance. Okay. We could have, as I mentioned before, done a reversing entry and then done it. And then posted the correct entry. So we could have debited service revenue, credited cash 50. So that just basically wipes out that entry that we made. And then debit cash, credit accounts receivable, the correct entry. But what we had just done, if we would have done that, is put two entries into cash that we didn't need to. So we would have had a debit of cash, incorrect entry, credit of cash, reversing entry, and then a debit of cash to the correct entry. But as you see on the correcting entry, we don't impact cash at all. We just use the accounts that are incorrect and correct it that way. So that's why it's a little bit easier to do. But sometimes thinking through what is happening is if you reverse that and then post that, you can kind of walk through the steps a little easier. Okay. We'll do another example. May 18th, Mercado purchased on account equipment costing $450. The transaction was journalized and posted as a debit to equipment 45 and a credit to accounts payable 45. The error was discovered on June 3rd. So the incorrect entry we did was debit equipment 45, credit accounts payable 45. Now when we analyze these, we need to figure out what is wrong. Is the amount wrong? Is the accounts wrong? Are they both wrong, or a combination? In this case, we look at the correct entry. What it should have been was a debit to equipment of 450. So we have the right account and the right debit or credit. We should have credited accounts payable 450. Again, we credited accounts payable, but only 45. So the only thing that's wrong in our entry is the amounts. So our correcting entry is going to look like our incorrect and our correct entry, but with just a different dollar amount. So we're going to debit equipment, credit accounts payable. The amount is $405. That's the difference between 450, what it should have been, and the 45 we did. That difference, $405, is our correcting entry. Yale Express is a short-haul trucking firm. It turned over much of its cargo load to local truckers to complete deliveries. Yale collected the entire delivery charge from the customers. When billed by the local trucker, they sent a payment for the final phase to the local trucker. They used a cutoff period of 20 days into the next accounting period in making its adjusting entries for accrued liabilities. So what that means is they waited the 20 days to receive the trucker's bills to determine the amount unpaid but incurred delivery charges so they can have their balance sheet correct. Okay, so they took the view that they're going to wait, get actual bills, and then do their adjusting entries from that. They could have estimated that and done an adjusting entry sooner. Republic Car Loading, another freight forwarder, frequently did not receive transportation bills from truckers until months after year end. Okay, so where Yale was waiting 20 days, this was months after. So the Republic waited months in order to include all the outstanding transportation bills in their year-end financial statements. Yale Express merged with Republic. Yale's vice president employed a 20-day cutoff for both firms. But what they didn't realize doing that is they missed millions of dollars of Republic's accrued transportation bills. So they only included what was received within 20 days. Months later, they received other bills that should have been back in the previous period. When they detected the error, made the correcting entries, these and other errors changed a reported profit of 1.14 million into a loss of 1.88 million. So over a $2 million error that they had in their financial statements. What might they have done to produce more accurate financial statements without waiting months? So if you didn't want to wait that, you could have looked at history and what kind of transportation bills had come in and made an estimate, and that's appropriate to make an estimate and book that estimate as your adjusting entries. Okay, as long as the estimate isn't too out of line, and we use the word materiality, it's not too much of a material difference, that's appropriate, and the auditors would sign off on that. So let's go through some examples of correcting entries. Sanchez Company discovered the following errors made in January 2027. A payment of salaries and wages expense of $600 was debited to supplies and credited to cash both for $600. A collection of $3,000 from a client on account was debited to cash $200, credited to service revenue $200. And the purchase of supplies on account for $860 was debited to supplies $680 and credited to accounts payable $680. Correct the errors without reversing the incorrect entry. So let's look at these one at a time. Payment of salaries and wages expense of $600 was debited to supplies, credited to cash, both for $600. Okay, first we have to analyze what was wrong. Debit to supplies, $600, credit to cash, $600. The amount is correct, $600. The correct entry should have been debit salaries and wages expense $600, credit cash. So the fact that we used cash and credited $600 is correct, but we had a debit to supplies instead of salaries and wages. So to correct that entry, we're going to debit salaries and wages expense is what it should have been, and credit supplies, because that's the account that was used that shouldn't have been used. That's our correcting entry. The next example, a collection of $3,000 from a client on account was debited to cash $200 and credited to service revenue $200. What was wrong with this entry? Well, pretty much everything. We should not have credited service revenue because we were collecting from a client on account. So we've already recognized the revenue and set up an accounts receivable. So we should have credited accounts receivable. And we used the wrong amount, $200 instead of the $3,000. So to correct this, we have to look at what the correct entry should have been. Debit cash $3,000, credit accounts receivable $3,000. Make additional entries to any accounts that we used correctly but with the wrong amount, and correct the accounts that weren't used, or correct the accounts that were used in error. So in this case, service revenue was credited $200. That is incorrect, so we need to debit service revenue $200. We debited cash correctly, but for the wrong amount. So $200 instead of $3,000. So we need to debit cash an additional amount, $2,800, so that the total is $3,000. And we should have credited accounts receivable $3,000 to recognize that our customer paid us. We didn't do that, so we're going to credit accounts receivable for the full $3,000 in our correcting entry. Okay, remember what we've learned. Debits always have to equal credits. So we do $2,800 and 200 debits, so $3,000 in debits, $3,000 in credits. Okay. And the last one, purchase of supplies on account for $860 was debited to supplies $680 and credited to accounts payable $680. So we just inversed the 6 and the 8. Okay. We used the correct supplies and did the right thing to them. So we debited supplies and credited accounts payable. That is correct. We just used the wrong amount. So our correcting entry is just going to be the difference. So the 860, what we should have used, versus the 680 that we did use, we're going to debit supplies at 180, credit accounts payable 180. Okay, so that's just, we use the right accounts, the wrong amounts, we just find the difference and put it in there. If this example was reversed, so the amount was 680 and we booked 860, we would do the similar analysis, but the entry would look different because we would have booked too much debit in supplies, too much credit in accounts payable. So the difference would be a debit to accounts payable and credit to supplies of the 180. So just because it's the wrong amount doesn't mean you just do the same entry like we did here. You got to make sure you got to look at the debits and credits of what the totals or what you should have been and what you did, and make adjusting entries from that or correcting entries from that. Now finally, we'll look at identifying the sections of a classified balance sheet. So a balance sheet we've looked at before. It shows assets, and then it shows liabilities, and stockholders' equity. It presents a snapshot at a point in time. To improve understanding, companies group similar assets and similar liabilities together. That's our classified balance sheet. So some of the standard classifications and what we're going to work with in this class is under assets. We're going to look at 4 different categories. We're going to look at current assets, long-term investments, property, plant, and equipment, and intangible assets. Under the liabilities and stockholders' equity, we're going to look at current liabilities, long-term liabilities, and stockholders' equity. Okay, so what does that look like? Here's an example of a balance sheet where we have our current assets. And what we do is we have a title that says current assets. We list the current assets. Then we have a total for that section, so we have total current assets. Another title, long-term investments. We list what those are. And we have a total, even though this doesn't show total. Long-term investments, you could have that, the total. Property, plant, and equipment. So land, equipment, less accumulated depreciation. We have a total there. And we have intangible assets. In this case, we have 1 patents. And then we get our total assets. Okay, so that's breaking up our asset accounts into 4 different categories. On the liabilities and stockholders' equity, current liabilities. So we list those current liabilities, and then we have a total. We look at our long-term liabilities, we list those, and then we have a total long-term liabilities, and then we get a total liabilities. And then under stockholders' equity, it's what we've seen before, common stock and retained earnings to get total stockholders' equity. Add up our total liabilities, total stockholders' equity to get our total liabilities and stockholder equity, which equals our total assets. Okay, so what is a current asset? So current assets are assets that a company expects to convert to cash or use up within 1 year or its operating cycle, whichever is longer. Okay, what is the operating cycle? It's the average time that it takes to purchase inventory, sell it on account, and then collect the cash from customers. So we refer to that as cash to cash. We're going to buy inventory, we're going to sell it, and we're going to collect the cash from our customers. That's our operating cycle. Most companies have an operating cycle that's far less than a year. Okay, so usually it's a year then that we look at for current assets. There are some industries that the operating cycle may be longer than a year. So then they would use that longer period to define their current assets. Okay. So let's look at Southwest Airlines, the partial balance sheet, and the current assets section. Okay. How do we list the current assets? In which order do we use? First, we're going to use cash, and then we put it in terms of how liquid the asset is. What that means is how quickly can we turn it into cash. So cash is already into cash, so we list that first. Short-term investments, we can typically sell those pretty quickly and within a day or two turn those into cash. Accounts receivable, other receivables, typically we're going to collect those in a short period of time, so we're going to list those next. If we're really short on cash, we'll get into it in another chapter. We can sell those assets off as well. Inventories of parts and supplies. So these are supplies that they're going to use in operating their business of flying people around the country. So that's going to be a little bit longer than accounts receivable to turn into cash, and then prepaid expenses and other current assets. As we've seen in some of our examples, you could have those for a year or multiple years potentially. So that's going to be the longest that you're going to use up. So you list those last. So the correct order of presentation in a classified balance sheet for the following current assets. We just went over that. So which of these represents liquidity from cash to non-cash? The answer is C, cash, accounts receivable, inventory, and prepaid insurance. Okay. Next, we'll look at long-term investments. This is investments in stocks and bonds of other corporations that are held for more than a year. So as a company, I can make investments in other companies, either buying their stock on the stock market or making an equity investment, but these are investments in other companies. Long-term assets such as land or buildings that aren't currently being used in operating activities is also part of long-term investments. So if we think about the Chicago Bears, they've bought the old Arlington Park in Arlington Heights. They are not using that land for part of their operations. They're not playing any games there, and they're not practicing. They're not doing anything with it at this point. So they would list that as a long-term investment. So that's what that means. So land and buildings that aren't currently being used in operating activities. And then long-term notes receivable would also be under long-term investments. Property, plant, and equipment. This is assets that have long useful lives, currently used in operations. We depreciate these assets, so it's allocating the cost of assets over a number of years. Accumulated depreciation is part of the property, plant, and equipment section. Property, plant, and equipment is also sometimes called fixed assets or plan assets. We'll see it also kind of condensed into PP&E. Instead of saying property, plant, and equipment, you simply say PP&E, and that's appropriate as well. Here's an example, Tesla Motors, their property, plant, and equipment section. So they have machinery and equipment, they have tooling, they have leasehold improvements, land and buildings, computer equipment, hardware and software, construction in progress. Okay, those are all assets that have long useful lives that they're using in operating their business. Okay, and then we have accumulated depreciation. So in this presentation, even though we will have separate accumulated depreciation accounts for the different categories, they're showing it on the balance sheet as just a total of accumulated depreciation, and then they get their net property, plant, and equipment, or net PP&E shown there. Intangible assets are long-lived assets that do not have a physical substance. Okay, we'll talk more in detail about intangible assets in a future chapter, but think of it as intangibles as franchises, copyrights, trademarks, patents, goodwill. You don't need to know how these are come about. Just know that if you see something like that, it goes into the intangible assets section of the consolidated or the classified balance sheet. So a review question, patents and copyrights are they current assets, intangible assets, long-term investments, or property, plant, and equipment? The answer we just talked about, they're intangible assets. Now let's look at the liabilities. Current liabilities. So liabilities are obligations we owe to people, things that we're going to pay. So anything that we're going to pay within the coming year or its operating cycle, whichever is longer, is our current liabilities. Common examples are accounts payable, salaries and wages payable, notes payable, interest payable, income taxes payable, and current maturities of long-term obligations. Okay, so we have the same definition as we did for current assets. It's the coming year or the operating cycle, whichever is longer. Whatever we choose for current assets, we have to have the same definition for current liabilities. So those need to match each other. So if we use the operating cycle, which is longer than a year, for assets, we have to do the same thing on the liability side. And then liquidity, if we talk about a company's liquidity, it's the ability to pay its obligations expected to be due within the next year. So We're going to compare our current assets. So those are assets we expect to turn into cash or use up within a year, compared to our current liabilities, which is what we expect to pay out within the coming year. We compare those. Hopefully we have more current assets than current liabilities, and that shows that we're in a strong financial perspective or position. If it's negative, meaning we have more current liabilities than current assets, does not necessarily by itself mean a bad thing. It just means that we're going to have to do something to create more cash to pay our current liabilities. But some industries, that's a normal cycle or a normal process that they go through at different times. So just that one measure as a negative doesn't mean it's bad. Definitely better if it's positive, but you have to look at other things as well besides just that one measure. So here's an example for Nike, their current liability section. So they're going to have current portion of long-term debt. They have notes payable. They have accounts payable. They have accrued liabilities. They have income taxes payable. So their current liabilities at this balance sheet was almost $8 billion. So it says it's in millions here in the title. So that means when we see this, it's 7,866 million, which is 7.866 billion. Okay. Now again, it doesn't show us what their current assets are, so we don't know how liquid they are. But if we talk about liquidity, can a company be too liquid? Short answer is yes. So if we have too much working capital, current assets less current liabilities, it's important to be liquid so you can pay your bills as they come due. You don't want cash tied up in extra inventory or extra receivables that aren't earning company money. So one estimate from the REL Consultancy Group, the 1,000 largest U.S. companies have on their books cumulative excess working capital of $764 billion. Okay. Companies could have reduced their debt by 36% or increased net income by 9% by not holding that extra working capital. Given that managers throughout a company are interested in improving profitability, it's clear they should have an eye towards managing working capital. They need to aim for a Goldilocks situation, not too much, not too little, but just right. Okay, so a lot of work done in companies to make sure they have the right amount of inventory so they can meet the customer demand, but they don't want too much because they're tying up cash that they can't use for other things. Okay, what else can they do? Extending generous repayment terms. So increasing the receivables and extending that balance are slowing the company's cash flow. Production managers must strive to minimize the amount of excess inventory on hand so that they have the right amount to meet the demand again, but they don't want some sitting there because then you're going to look at tying up cash and then also worry about obsolescence. So those are just things to think about as we're learning about some of these terms. Okay, long-term liabilities are obligations that a company expects to pay after 1 year. So mortgages or long-term notes payable, bonds payable, those are examples of long-term liabilities. And a question along those terms, which of the following is not a long-term liability? So we have bonds payable, current maturities of long-term obligations, long-term notes payable, or mortgage payable. Okay, get a hint in the answer here. The current maturities would be a current liability. Okay, so what that is parts of these other potential long-term liabilities, bonds, long-term notes payable, or mortgage payables that are due that they have to pay within a year. So we'll break out the part that's due within a year and put it in the current section and leave the rest of the balance in the long-term section. And the stockholders' equity or the owner's equity. Again, we talked about 3 different types of ownership, proprietorship. There'll be one capital account in that section of the balance sheet. If there's a partnership, There'll be a capital account for each partner. And if it's a corporation, most of the examples that we look at, there'll be common stock and then retained earnings. All right, let's do some examples here. So we have a list of a number of accounts, and we're going to match each of the following accounts to its proper balance sheet classification shown below. Okay. If the account is not a balance sheet account, we'll just use NA for this purpose. So salaries and wages payable, that would be a current liability. Service revenue, that's an NA because that's an income statement account. It's not on the balance sheet. Interest payable, current liability. Goodwill, again, that's one of those new terms, and that's an intangible asset. Debt investments, short term. Okay, I'll help this out here. Let's use short term, so it's going to be a current asset. If it just said debt investments or debt investments long term, and that would be a long-term investment. Mortgage payable, which is due in 3 years. Again, the description gave us a little bit of hint here. That's a long-term liability because it's more than a year away. Stock investments, long-term. Again, they gave us a little hint saying it's long-term, so it's a long-term investment. Equipment, that is property, plant, and equipment. Accumulated depreciation equipment. Again, it goes on the balance sheet with property, plant, and equipment. Depreciation expense. It's an expense account. It goes on the income statement, so it's NA for classified balance sheet. Common stock, that goes into stockholders' equity. And finally, unearned service revenue, that goes as a current liability. Okay, so that's classifying the different accounts into the classified balance sheet. Okay, so it's just taking what we normally think is balance sheet accounts and breaking it into those 4 categories that we've talked about. On the liability side, it goes into either current or long-term liabilities. That wraps it up for Chapter 4 and our first part of our class. We've gone through the accounting cycle. We've learned how to journalize. We've analyzed transactions, creating our financial statements, even taken our balance sheet into a classified balance sheet. So the other chapters from here will be building on these concepts. Again, I said at the beginning of the class, this is a cumulative class. So everything we've learned so far, we're going to be seeing again and again. So make sure you understand the information so far. Again, reach out if you have any questions or are struggling with anything, and we can get you some help. Thank you.